Good morning, everyone, and welcome back to the Daily Hunt for Multibaggers. It's Friday, March 6th, 2026, and we've got a fresh batch of market intelligence from yesterday's activity to dive into.
That's right, Ethan. Our AI has been busy sifting through a pretty substantial number of hot leads today, flagging quite a few different stocks. It seems the market sentiment is a bit of a mixed bag out there. Some pockets of serious optimism, but also a good dose of caution, especially when we start digging into the numbers.
Absolutely, Brooke. There's certainly no shortage of discussion, and we're seeing some interesting shifts in focus. Let's not waste any time and jump right into the first stock on our list. All right, first up, we're looking at DHT Holdings Inc., DHT. Our analysis flagged 13 mentions for DHT. Now, there's a really compelling bull case floating around social media, suggesting the tanker market is on the brink of an explosion. Geopolitical tensions in the Strait of Hormuz are tightening the market, driving up ton-mile demand and spot rates for these VLCCs, which DHT, with its spot market exposure, is perfectly positioned to benefit from. There's even talk of another company, Synacor, trying to corner the VLCC market, which could push rates even higher. It was a buy for us back in February, so the momentum seems to be building.
Well, Ethan, while that geopolitical narrative sounds exciting, the KPIs paint a slightly different picture for new entrants. The stock has already seen a massive run-up, climbing from a 52-week low of about $9 to its current price of $18.54, which is very close to its 52-week high of $20.55. Many users are pointing this out, saying things like it's already pumped, or if it's already happened, it's already reflected in the price. The tanker market is also notoriously cyclical and volatile, and if those geopolitical tensions ease, the stock could drop fast. Plus, a debt-to-equity ratio of 38.432 is on the higher side, signaling significant reliance on debt. Given it was a buy previously, this feels like the market has already moved.
I hear you, Brooke, but the news pieces are very supportive, mentioning DHT Holdings charters VLCCs and adds board expertise for cash flow clarity, and articles like Frontline and 6 more stocks getting a boost from a Strait of Hormuz closure. This isn't just speculation. There are real-world developments reinforcing the bullish sentiment. It indicates strategic moves to secure cash flow, which could further improve its financial metrics down the line.
Agreed, those could potentially improve future KPIs, but my concern is the current entry point. The market appears to have priced in a substantial amount of this future potential. For today, based on our AI-generated insights, DHT is a stay away. The risk of buying in after such a significant run-up with so much uncertainty around the duration of geopolitical events outweighs the potential upside.
Okay, moving on to a perennial favorite for discussion, Palantir Technologies Inc., PLTR, with 28 hot leads. Now, the main social media post was aggressively bearish, literally saying, "Fuck PLTR." But the user commentary? It's overwhelmingly bullish. People are buying more, talking about price targets of $170, and ridiculing the idea of betting against it, especially with its deep ties to defense spending and AI. There's this belief it has massive earnings with insane backlog and no end to the growth in sight.
Ethan, that community optimism is palpable, but why spreadsheets are screaming caution. Yes, the company has strong revenue growth at 0.7 and a healthy net profit margin of 0.36, indicating strong operations. However, the price-to-earnings ratio is an astronomical 242.33, and its price-to-book is 49.42. That's incredibly high, suggesting a massive amount of future growth is already priced in. One user even admitted it's overvalued as hell. And let's not forget the high beta of 1.739, meaning it's highly volatile. We've given it a stay-away rating many times in the past, and despite the current hype, the underlying valuation risk is still there. But Brooke, the news is largely positive. Earnings estimates moving higher, Wall Street analysts think 30.82% upside, and veteran analysts drops eye-popping price target. This suggests that even with the current valuation, analysts see further room to run, especially with ongoing geopolitical events driving defense spending on AI. Those operational KPIs are looking strong, and if that growth accelerates further, the PE will naturally come down. It could come down, Ethan, but we're looking at a huge amount of speculation in that price. While the news is positive, it doesn't change the fact that you're paying an enormous premium for future expectations. Even a slight miss on those expectations could lead to a significant correction, especially with that high volatility. Therefore, for Palantir, our AI-generated insight remains a stay away. The valuation is simply too stretched for new money at this point.
All right, let's talk about Adobe Inc., ADBE. It's got 16 hot leads today. The stock pitch we analyzed presented a really strong bullish case. It's undervalued at around 12 times forward earnings, has sticky government contracts, and is perfectly positioned for AI to augment creative professionals, not replace them. We've never rated Adobe before on the show, so this is a fresh look.
And it's a look that reveals some serious concerns from actual users, Ethan. The AI-generated insights lean neutral to slightly bearish, and here's why. Users, especially those in post-production, are reporting declining subscriptions and a general downturn in their industry. More critically, daily Adobe users are saying their AI hasn't improved in a year, and they're replacing it with free alternatives. We're also seeing market share loss in the PDF space. While the PE of 16.37 might seem attractive, the stock is currently at $281.74, significantly below its 52-week high of $452.51. That massive drop tells a story of market concern. The revenue growth, while positive at 10.5%, is showing signs of slowing.
But Brooke, the post suggests that market is mispricing it, and it has exceptionally high return on equity and a solid net profit margin. Plus, upcoming earnings are anticipated to grow. These are strong fundamentals that could help turn the tide, you know?
They could, but Jefferies and HSBC have already cut their price targets, and the qualitative feedback from actual users about stagnant AI and customer attrition is alarming. Those are forward-looking indicators that could directly impact revenue growth and profit margins. We need to see clear evidence that Adobe is addressing these competitive threats and innovating more effectively. For these reasons, ADBE is a stay away.
Finally, we're rounding out our analyzed stocks with Apple Inc., AAPL, with 10 mentions. Despite the limited social media chatter, our AI pulled together a lot of interesting data. News reports are calling Apple's latest product a game changer and describing a golden goose Gemini partnership that could propel it towards a $5 trillion valuation by 2026. We've rated Apple as a buy many times in the past, and its robust profitability and strong insider buying, indicate a company with a lot of potential.
Ethan, while the news sounds exciting and insider buying is a positive signal, Apple's current valuation metrics are incredibly high. The price-to-earnings ratio stands at 33.24, and the price-to-book is an eye-watering 43.39. This means an enormous amount of future success is already baked into the current share price. And let's not overlook that debt-to-equity ratio of 102.63. While Apple has strong cash flows, that's still a significant reliance on debt. Also, there was recent news about a cybersecurity threat targeting older iOS versions, which could be a concern for user trust. For new investors, you're paying a premium for speculative future events, which makes it quite risky. This is a downgrade from prior buy calls.
But with those new products and partnerships potentially on the horizon, Brooke, Apple could redefine its growth trajectory. It's got a 27% net profit margin. That kind of fundamental strength can withstand market jitters.
True, but for now, the future growth is speculative, and the current valuation offers very little margin of safety. Therefore, today, our AI-generated insights suggest Apple is a stay away.
All right, Brooke, let's wrap up today's hunt. What's our compiled list of candidates for deeper analysis?
Well, Ethan, after today's rigorous analysis, here's what our AI has flagged for further investigation. Investigate as buy? None. Investigate as cautious buy? None. Investigate as speculative gamble? Palantir Technologies, Inc., PLTR.
And that's all the time we have for today's episode of the Daily Hunt for Multibaggers.
This podcast is for informational and entertainment purposes only. The content is generated by artificial intelligence and does not constitute financial advice. Listeners should conduct their own research or consult a licensed financial advisor before making investment decisions. We are not responsible for any losses incurred. The market is a wild place, and knowledge is your best asset.
Indeed it is. Thanks for tuning in, everyone. We'll be back on Monday with more insights from the Daily Hunt. Have a fantastic weekend.